Morning, everybody. Hopefully, you had a wonderful weekend. We got some intellectual stimulation today, so we'll get started here. Whoops. So last week we did the risk reward, and we added that cable or added back in because it used to always be there, and for some reason it got dropped off. But added that cable TV story back into the tutorial, into the crib notes, and into the audio for learning the risk reward. So that's all back in there. 5-minute moneymaker. Last week, this guy went from average to top salesperson's company in just 12 months. How? Please take 5 minutes and read this article. If you haven't read this article, yada, because if you can start incorporating some of these 7 easy ways to think, so you're not even working, it's just changing the way you think can really affect your how well and successful you are. So today we want to talk about the things that can really zap retirees in retirement, and it's unforeseen type of things that they don't even think about. When Transamerica here did a survey of retirees, and they asked them, what are your priorities? 39% said just getting by to cover basic living expenses. So that's that half of the population, retired population, don't have any money, and they're just trying to get by. 34% paying healthcare expenses, paying off credit card debt, building emergency savings, continue to save for retirement, paying off the mortgage, creating an inheritance or financial legacy, paying off other consumer debt, paying off long-term expenses. And guys, what have they found out? Our parents always tried to pay off their house before they retired. Is that still happening today? Or are there an awful lot of people who are retired that still have their house payment, unfortunately? Do you have retirees that still have house payments? Yeah, and while all our parents, that's the one thing they did, is they paid off their home before they retired. And you got guys, and where's credit card debt now as compared to 2008? Higher, exactly. And where is this is incredible. Where's home equities compared to 2008? Higher, still higher. It's crazy, crazy. So retirement, retirement nest egg calculators, running out of money versus running out of time. What do I think about retirement nest egg calculators? For those of you who've been on for a while and heard me go on and on and on. Do I like them or do I don't like them? Yeah, I don't like them. Why don't I like them? I think they're bogus. Why? Yeah, they're assumptions. That's right, Mark. They're false assumptions. Because we have to pick, for retirement calculators, we have to pick out an inflation amount. We have to pick out a rate of return. We have to pick out how things, we have to predict the future. But let's not even talk about that right now. Let's say we could pick out a good number for inflation. Let's say we could pick out a good number for an average rate of return, or we're conservative and only guess that we're going to get half of the return that we're actually going to get. There's still a reason why it's bogus. Anybody have a guess onto why those things are still bogus? Well, fixed, Mark, I would agree with fixed, but what do you mean by fixed? Ben, can't tell the future. What do those things not include? What do those things not include? Yeah, David, right. Crashes, withdrawal times, market losses. All those things are correct, but there's even bigger things that it doesn't include. Well, actually, we're going to cover all the things that those don't include. There we go. Kevin's got it. Unusual events. Unusual events. Medical issues. Perfect. Now we're getting, why healthy clients need to save more money for retirement. There's a counterintuitive thought. Healthy clients are more likely to have higher medical costs. Why, guys? Why are healthier clients and wealthier clients likely to have higher medical costs? Now, they're going to live longer. So the new report now is an average healthy 65-year-old couple retiring in 2019 will pay more than $387,000, almost $388,000 in medical costs, not including long-term care. So that's just total lifetime costs, including premiums for Medicare Part D, outpatient coverage, prescription drugs, dental, supplemental Medigap, as well as out-of-pocket outlays for dental, hearing loss, etc. $387,000. Is that a small chunk of change or is that a big chunk of change? How many people are including that in their retirement plan? That's how much they're going to need or spend. How many people are including that? And like I said, does this include long-term care? Yes or no? No. So these are the kind of things that aren't included in. It's the things out of left field that we don't plan for, but does life really care if we plan for something or not? No, it doesn't. So how to be prepared for an unforeseen disaster? The Society of Actuaries ran this, where I got all of these tables that are upcoming, ran a huge study on shocks and unexpected expected expenses in retirement. And they asked people, first of all, the key findings were this, is that retirees are resilient and will make necessary changes. So what do you think retirees are resilient and will make necessary changes mean? That's right, Mark, you got it. Nick's got it. Nick said eat ramen. Right. So they're resilient. They'll make it. They'll survive. They won't just go drive their car off a cliff. What they'll do is keep cutting back and cutting back and cutting back what's necessary to remain alive and kicking. Is that really the kind of retirement anybody desires? No. Now, here's the thing. The more shock events, the more things that happen to you that you don't plan for, the harder they hit you. Most people, they found, can survive pretty darn well if only one shock hits them. But multiple shocks occur regularly. And they've asked people, they asked retirees, what are you going to do if one of these things you didn't plan for happens? What's your plans for that? Guess what they said? Guess what overwhelmingly they said? I don't care if they're rich, middle class, or poor. Guess what they said? Kirk's got it. Some of them said, I'll deal with it when it comes. If it comes, it comes. I'll just deal with it. All I know is I'll figure it out. So that's pretty fatalistic, isn't it? So these people, what are they living on, these people who say these things? What are they living on? That's right, everybody's getting it. Hope. They're living on hope. I hope these things don't happen. If they happen, they happen. I guess I deal with it then. I just hope they don't. Is that a good financial plan? No. So what kind of impact did it, then they asked, when these things did happen, what kind of impact did it have on you? So they said their assets declined. They had to reduce spending. But, I managed. I mean, I lived on less. I drove my car till it couldn't drive anymore. I ate, didn't go out to eat anymore. And then, they make do. And I've seen people in my family this happen to, and they do survive. But that's how they spend their last 10 years, surviving. That's right, Nick. That's a sucky retirement. Just surviving is a sucky retirement. So what was the most problematic? Well, long-term care costs obviously was the most problematic. Divorce was a huge problem, and loss of a spouse. So of these things, do these things occur to people? Well, long-term care does occur to some people. Divorce occurs, unfortunately, with some people. But how many people does losing a spouse affect? Yeah, everyone. And how many people have a plan for that? Virtually nobody. And what is one of our elevator bullets about? This very thing. Now, there's other things that can happen too, which are devastating shocks, such as fraud. Missy and I actually had a friend. She actually worked for us part-time, and this is a lady who was, I don't know, 65 years old, and she had a paid-up house, $250,000 in assets, a good, decent Social Security, so she was doing fine. And guess what happened to her? She found a friend online. And guess what that male friend did to her? I forget. I don't know what country was he in, Missy? You
I
remember?
believe it was India. I think he was from India.
India. And he said everything that she wanted him to say. Now, um, her she was working for an employer that her employer told her that he was scamming her. Her financial advisor told her he was scamming her. Her banker told her he was scamming her. And did she believe any of them? And she lost all of her money, sent all of her money to this guy, took out a loan on her house, so she no longer has a paid up house. She lost her house sending money to this guy. Yeah, she was lonely. There's a lot of 65-year-old people without family that are lonely. So fraud can be devastating as well. Does not occur often, but when it happens, it's crippling. So here's a Society of Actuary questionnaire. They asked, have you or your spouse or partner experienced any of the following during retirement? So retirees is the blue and retired widows is the green. Major home repairs, looks like about a third of people. Major dental expenses, between somewhere over 1 and 4. Significant, and first of all, major dental expenses. We're in our family, we're experiencing one right now. Is that covered by Medicare? And no, that's right, it's not. And dental expenses when you're retired, are they usually small things or are they huge things? And do they cost like hundreds of dollars or thousands and thousands of dollars? Thousands, like 10K can happen, 6,000 can happen, 5,000. Yeah, it can. Yeah, those are big things. Significant out-of-pocket medical and prescription expenses, which we just talked about. That's part of that 387,000 the average couple, 65 couple will spend. A drop in home value of 25% or more. That's a big chunk of people. Illness or disability, running out of assets, sudden loss of total value of savings of 25% or more. What can we say about this, guys? Sudden loss in total value of savings, 25% or more, only 14% or 13%. There's two things that we could take from this. What are the two things? Because first of all, 25%. Has there been two over the last 20 years? Has there been two corrections that were 50% or more? Yes. So there's two things that we can take from this. Sudden loss of savings of 25% or more. One is that most people did not have any money in the market because they're poor, or people have what kind of memories? Yeah, short, bad, poor memories. Family emergencies, death of a spouse. Okay, now we start to see it. And obviously, I'm a little confused because only 50. I don't know how this stat works. Somebody help me. Only 56% of retired widows have experienced the loss of a spouse. What should that? Oh, okay, Nick said maybe they had two. Okay, I guess that's. I would think. What percentage of widows should have experienced the loss of a spouse? You would think 100%. Not exactly sure how that what that occurs there. So loss in total value of savings of 10% or more. Again, only 10%. So victimization of fraud or bankruptcy. So this I'll start to get smaller. But here's some of the quotes they had when they did the focus groups. In 2013, I got colon cancer. The medical costs and stuff like that was unreal. I've had to spend $3,900 to come right off the top. Dental, I mean, you start to get into the thousands of dollars sometimes and no insurance. We just separated. I had my own money and investments, and he had his. We had one account, and that was the house account. So we just had to split the house. They found that divorce, when you're retired, guess how bad divorce is when you retire? It's devastating. I've had our house upkeep. Guys, I've experienced this. I've had our house upkeep, furnace, driveway. The last month, I spent $2,500 on one expense, $3,600 on another expense. That happened to me last month. More than 25, more than 3,600. That's in 1 month. In a couple of years, my roof went and my furnace went, everything. My daughter lives alone. She was on her way to teacher's meeting, and she crossed the street and was hit by a car. Since then, she's had MS and did not pay anything. We got nothing now, and she has no job. It's very expensive. So if you take a generic, your prescription is $25, but then he takes 7, and one of them is not generic because it isn't a generic one, and his doctor would probably want him to take it anyway, so it adds up. The biggest thing about 18 years ago, I had a lot of shares in Citigroup, and they were paying like $17,000 a year. Dividends, that went down to $30. Or any of these things, boy, I don't think that would happen to anybody. Or could these things happen to anybody? Are these completely weird things, or could they happen to anybody? Yeah, anybody. Survey question. Have you or your spouse experienced any of the following during retirement? To the best of your knowledge, did either of your parents experience the following during retirement? So the parents, again, they're asking the people who retired to think back and make a judgment whether their parents did, and also they're asking whether you did. So major home repairs or upgrades. We're saying 28% of retirees say they had to, but they're saying only 8% of their parents had to. What does that tell you about their knowledge of what was going on in their parents' lives? Unless they watched their parents' house just completely, go to dust around them. Why would they have more upgrades than their parents? Well, there could be one thing, which is that were their parents able to live in that 1960s tract housing till the day they died? And they didn't change to granite countertops, and they didn't change to the new flooring, and they didn't have $1 million bathrooms. So yeah, I would say this is probably accurate because our parents lived with what they had. We have to have, we watch TV and we see every single house except for the what's the house? Roseanne's house is a piece of crap, but every other house you see has what kind of a house does everybody live in? $1 million houses. So we have to have those too. So I think that's probably accurate. Major dental expenses, at least 1 in 4. Drop in home value, 25%. Illness or disability. Of course, they saw their parents experience this because their parents were older, and their retirees have yet to experience this because they're younger yet. Sudden loss in total savings of 25% or more. Again, apparently all their parents were invested in what? Savings accounts. And we did see that a lot. That greatest generation, were they scared, or were most of the greatest generation, did they like the stock market, or did they stay a lot in treasuries and in saving in banks? They're risk adverse. So that could very well be. But either this 14% that experienced a total loss of retirees, that means either they did not have any money to invest in the market, or again, what's happening with their memory. Short. And I talked to 2 advisors last week. Guess what their memory is? They realized, when I asked them how many times has the market fallen 50% or more, they both said in the last 20 years, they both said twice. Now these are newer advisors. And then I said, so how much of your clients' monies, retired clients' monies, are in the market? Guess what they said? Yeah, almost all of it. But I've got money in bonds. Guys, are bonds a safe place for clients to have monies right now? That's right. How about bond funds? Yeah. So now, does that mean that they're bad advisors? No, it means what? We all have what? Short memories. We have to what? Pay attention to avoid making mistakes. If we don't pay attention to our inclination to forget things, our inclination to explain things away, our inclination to basically think we're smarter than we are, what can happen? Yeah, recency bias, Kevin, that's what it's called. Going on Medicaid, loss of capacity. Survey question: number of shocks and unexpected expenses. Unexpected expenses experienced retirement. 28%, 1 in 4, had none. 13% of widows had none. So we got about half have had 1 or 0. What do we say about them being able to weather one shock? They could or couldn't, most people. Yeah, most people could. Yep, till most people could. Problem is, first of all, are they done with their lives? Are this 50% done with their lives? No. So do you think that they're only going to get 1 to 0 sometime in their life, or what's likely to happen? Because 18% to 24% experience 2 shocks, 3 shocks, 4 shocks. So 1 in 4 of widows experience 4 shocks. What do you think happens when a widow has received 4 shocks they did not plan for? What's happened to their retirement? They're back to that suffering the last decade of their life, just barely surviving retirement. By approximately how much, if at all, did these events reduce your level of stress? Excludes those who have not experienced any shocks. So I don't get reduce. Wouldn't it be increase instead of reduce? So I just basically cut and paste these charts from the Society of Actuaries. I think it's reduce your level of stress or increase your level of. Oh, duh, what am I thinking? Sorry, I can't even read myself. Sales. That's a salesperson's problem. Can't read more than one sentence before they lose track of things. By approximately how much, if at all, did all of these events reduce your level of assets, not your stress, assets? So a quarter of them, or close to a third, didn't reduce it at all. 1 to 25%, guys. That's about half again. A little over, but maybe somewhere between half and 2/3. But that means 1/3 of the people. How much did those things? So 1/3 of people, 1 out of 3. 1 out of 3. What happened to their assets? What happened to that 1 out of 3? What happened to their assets? Significant losses. Significant losses. And we've talked about sequence of returns. If you have a significant loss and you need to pull out money, what's going to happen to that loss? Even if you have 1 to 24% losses and it lasts for 2 years, what happens with sequence of returns? What happens to your losses if you're pulling money out? Yeah, it's amplified. By approximately how much, if at all, did these events reduce the amount of money you and your spouse are able to spend each month? So between a third and close to a half didn't expect change it at all. So again, half to 2/3, only had to reduce by 1 to 9. But again, reducing your spending by 10 to 24% or 10% all the way up to 50% or more, is that a big or a small change in your retirement lifestyle? It's a huge, even at 10%, that's a big change in your retirement lifestyle. That's a vacation you can no longer go on. That's a car you have to drive for another 3 or 4 years. That's a big change. That's a big change. So the focus groups, you can do a lot of things that don't cost money. So you just spend more time on research and look for those special stores. You can eat well, just not as much. Well, it makes you feel comfortable if you know you have can kind of stay at the same level. I don't want to decrease tremendously because that might affect my lifestyle. With interest rates falling, declines, etc., I feel maybe you might have to tighten your belt or if it gets below a certain point. I had to replace the air conditioning this year, dishwasher, but I think the prices are pretty competitive. You shopped around. So these people are living what? I'm a thrifty myself. Some people call me cheap, but I get shopping around. I get getting things on sale. But in retirement, when you have to worry about, can I replace the dishwasher, or do I have to just let it stay broken, or do I have to, these are tough ways to spend retirement. Again, yeah, I can wash my own dishes. But if you can't afford a dishwasher, guess what else you can't afford? You better pray and hope that your car doesn't what? Break. So these are hard things. How well have you been able to manage these new financial constraints? So basically 2 in 10, no problem. But then look at most people that a little over 50% said somewhat well, which somewhat well means they had to what? They had to cut back in one shape or form. So they're, the one question I would ask people, the people we want, do they have money? Are they going out to eat when they want? Are they driving the car they want? Are they going on vacation when they want? Yes, yes, yes. But the problem is any of these things happen, are they any longer going out to eat when they want, driving the car they want, or going on vacation when they want? And when one of these, or not one, most people can weather one, but more than one of these things happen, what happens? They have to start changing how they live. They're able to manage. They're not in the poorhouse. It's just that they have to start counting more pennies. They have to reduce where they go on vacation or how many times they go on vacation. They have to drive that car a little bit longer or not get the car they wanted. Those are the kind of things that happen. So to what extent do you agree or disagree that there was something you could have done ahead of time to lessen the financial impact of these events? So this is, again, human nature. Could a lot of these people done something to prevent the change or the cost of what that unforeseen circumstances? Yeah, most of them could have. They could have what? Had more money in the what? Bank, a larger rainy day fund. But 1 in 10, to what extent do you agree or disagree that there was something you could have done? So these 8 to 7%, they say what? They know. That's that 1 in 10 person that you meet that's what? Fiscally responsible. They know how life works. Then you have that basically a third of people saying, yeah, I know I could have done. There's probably something I could have done. But look at how many people are in denial. That's 60, close to 2/3 of people are in denial. So 1/3 of people said, yeah, I could have probably done something about it. 2/3 said, no, there's nothing I could have done with it. Because that would have required what? What would this have been able to, if you could have done something about it, what could they have done? What would, planning, yeah, what else would it have, discipline. Yeah, discipline. Yeah. And most people don't want discipline when it comes to their money. That's one of the reasons why when we talk about when we're gathering data at that first meeting, and we're talking about how much money do you spend, we always have to couch that in what? Now you're going to spend what you're going to spend. I'm just doing this to find out if you're spending money that you're being taxed on. If there's money that you're not spending that you're paying tax on, I want to be able to remove the taxes on that. So you're going to live your life the way you are. I'm not here to put you on a budget. I'm just looking for, if there's money that you're not spending, I don't want you to be paying taxes on it. So that's what I'm looking for. That. See, what I'm doing there is saying what? I'm not going to touch your income, because if you start talking to retirees about changing their income, are they going to listen to you at all? Not changing their income, changing their expenditures. Are they going to listen to you at all? No. They tune you out. How many of them want to tighten their belts? We found out they will. When will they tighten their belts? Before something happens or after? Yeah, after. And unfortunately, how much more do you have to tighten your belts after it happens as compared to before it happens? If you did some planning, how much yes, you're going to have to end up, if you did a little planning, you tighten your belts a little bit and really protect yourself. Instead, if you wait till it happens, you have to tighten your belts a lot. So did your spouse consider and plan for how you would respond if you lost a spouse? Considered and made plans, so about 38 to about a little over a third considered and made plans, but 2/3 did what? Doesn't matter whether they considered but didn't make a plan or didn't make a plan. Doesn't matter. 2/3 of them did what? Nothing. Financially, my husband's dad made half of the pension come in. With Social Security, he was making a maximum, and I had $800 a month. When he died, they put it together, and I get the max. So I lost the Social Security, and I lost half his pension. So yeah, it made a difference. I didn't starve to death, but it did make a dent. If my wife passed away today, I'd be up a creek. I don't even know where the money is, and that could be obviously she takes care of the money, so in both ways. When my husband passed away, I lost Social Security. I got part of it, but being one person rather than two, it's okay for me. Like I said, I'm not rich, and I'm frugal too. Again, this is a woman who's living the life, right? No, she's surviving. Most people don't plan for the death of a spouse. Again, that's why one of our elevator speeches, mini elevator speeches, or our unique selling proposition is about that. On the whole, do you think your parents' experiences made you more or less concerned about your financial security in retirement? Much more concerned? 10, 15%? Somewhat more concerned? A third? So we got what? A little less than half. Looks like about, a little less than half were somewhat concerned, but then half said what? Did they learn from their parents' problems? The other thing is that baby boomers generally more affluent or less affluent than their the greatest generation parents. More affluent or less affluent? Yeah, they're more affluent. Now, unfortunately, our kids are going to probably be less affluent than us, but we're probably the richest generation, at least from the compared to our parents and compared to our kids. We're the richest generation. We don't know what's going to happen in the future, but right now we're going to be the much more than our parents, and we're going to be probably more than our kids. But that means that half of these people, do they learn from their parents or do they not learn from their parents? Half of them did, half of them didn't. Yeah. So the problem being is are boomers as willing to live frugally as their parents were? No. So they're judging, do I need to make changes as compared to what my parents did? No, because I'm a lot more affluent than my parents were. But you know what? They're not adding to that is what? They're more affluent, but they also spend what? Way more. The definition, what is the definition of wealthy? What is the definition of wealthy? Definition of wealthy is having more money coming in than you're spending. That's what the definition of wealthy is. Having more money coming in than you're spending. And many of us, I mean, you've experienced this with boomers. What kind of car do they want to drive? What kind of vacations do they want to go out? What kind of bathrooms and kitchens do they want to have? Are they very good? Are boomers very good at discipline and putting money away if given a choice between a beautiful bathroom and putting some money away for a rainy day fund, what are they going to choose? 9 times out of 10, or maybe 3 times out of 10. Yep. So what did you do as a response to a financial stress that your household experiences? What I'm worried about is these two groups here. So I got help from others. 20% got help from others. Borrowed using payday lending. Hopefully our clients aren't doing that. It looks like most of them aren't. Mortgaged home or increased 7%. Borrowed from bank. Withdrew from savings. Withdrew from savings. Cut expenses. This is where the people we worked with, this is what they did. They withdrew from savings and they cut expenses. Again, we're asking people to do what? Withdrew from savings, what we're telling them to do. And again, if it's during up years, that's okay. But if it's during down years, what have they just done to their retirement? Gotten killed. Oops, gotten killed. And cut expenses. So 50% and 21% cut expenses. So what have we asked them to do? Change their lifestyle. Percentage of respondents aged 70 and over who best describe how hard it would be to pay for an unexpected expense in various amounts. Look at this. I could easily pay for expense of $500. 85% of them said they could. $1,000, half of them said they could. 5,000, 25% said they could. 10,000, 23%. So about one in four could actually easily do that. The rest are saying what? The other 75% are saying what? And really, when we're talking about an unexpected expense, is it more likely to be 5 or 10,000 or 500 or 1,000? I mean, what's an air conditioner cost? What's a furnace cost? What's a roof cost? What's a flooding in the basement cost? When a kid needs help, what do they need help with? $100 or $1,000? So this thing, 3 out of 4 people that we work with are not able to handle big expenses. So averages can be misleading. The risk is that averages can disguise the impact of shock events. The best strategies to preserve assets without shocks may not be the best strategy once the shock events have occurred. Making retirement decisions based on averages increases the risk of running out of money. For example, the level of retirement wealth necessary to be 95% confident of having sufficient funds to meet all cash flow needs is much higher than needing on average. These extreme differences are largely driven by shocks and variations. So that says, should we be looking for saving enough to be the average, or should we be looking to be well above average in how much we need to save? Should we be looking at average rates of return that are high, or average returns be conservative in our average rates of return? Yeah, low. Impact of reducing spending varies. Moderate and high income households can successfully retire with 20% less savings if they're willing to cut their budgets by 15%. Reduced spending does not significantly reduce the impact of depleting assets of a median income family because in this demographic, shocks are the major driver of asset depletion. So if somebody has $500,000, how much can a shock hurt? If somebody's got $5 million, will a shock hurt them? No. Somebody with $500,000, though, when they retire with $500,000, they think they're what? Most of them. Yeah, they don't think they're wealthy, but they think they're okay. They think they're good. How much can a shock affect somebody with a $500,000 portfolio? Massively. It can kill it. Conceptually, we view long-term care as an event that happens to about 70% of seniors. This is the Society of Actuaries. We view that happens to 70% of seniors. So what is are actuaries bozos? Or are they the people that crunch the numbers? Do they know what they're doing? And they're saying 70% of seniors will experience long-term care. Not all these events will be long-term duration. I mean, I've come to the conclusion that about a third of people won't have any long-term care at all. Another third will be able to handle it, mostly because the long-term care event, is going to be of short enough duration or not expensive enough for other reasons. For instance, a family member providing uncompensated care will step in. But that means a third of the population will have long-term experience with substantial proportions. Costs a lot of money. Reading this report, though, is enlightening and seeing proof yet again why getting people to focus on risk is so difficult. For instance, when the respondents were asked about financial shocks and unexpected expenses, the two most frequently mentioned items were home repairs. Guys, how much is home repairs going to hurt them as compared to losing a spouse and their Social Security or their pension or long-term care? Not a lot. It's minuscule. Dental expense. I mean, yes, home repairs are expensive. Yes, dental expenses are expensive. Out-of-pocket medical and prescription expenses are expensive. But long-term care in this picture, or loss of a spouse or divorce, indeed, about a third would face that eventuality to a serious degree, even more if you were to account for long-term care. So he's saying 33% are going to be affected by long-term care costs. But guess what? Less than a third are the highest one that people are worried about is home repairs, and it's less than a third. It's less than 33%. Less than 33%. Less than 33%. So they're saying that most people are living in what? La La Land. La La Land. The Society of Actuaries 2015 survey does reveal that while retirees were able to make adjustments and deal with unexpected expenses in a number of areas that did not include, so they're able to make adjustments when it does not include long-term care events or divorce after retirement. Both of these shocks had a major impact. Another interesting finding is that most interviewees, 6 in 10, did not think that they could have done anything to avoid the shocks. So why plan if that's your thought process? As noted in the introductory piece, this is an interesting finding. It seems consistent with the relatively low interest rates in buying risk protection products. It also indicates a lack of thinking about alternative financial planning methods. For instance, setting aside amount for some sort of fund that would not remove the expense, but at least would shift it from being unexpected to being somewhat planned. So one of the things that we should help people is that they should be at least aware of is what? Long-term care. So I would highly, highly, highly recommend that if you haven't talked to Jerry or Matt about the types of long-term care that are available, and again, not long-term care insurance, because that's a big expense. Does anybody want to spend or write a check for premium to long-term care expense? No, they don't. And what have we found with the entities that we're offering long-term care where you pay premiums? What are happening to those entities? What's happening to the premiums? They're skyrocketing. Not going up 10% a year. They're skyrocketing. They're skyrocketing. But there are options with lump sum funding that are extremely effective and reasonable. So if you haven't talked to Jerry or Matt about how to take long-term care without affecting their budgetary, causing them more expenses, you should talk to Jerry and Matt about those things. So why do people avoid this? It's also why I show people the Survivor's Guide. I show people the Quality of Life Directive, but many of those people 4 years in a row had not filled out those documents. Why? I never force them because they don't want to think. Some people don't want to think about unpleasant things. They're also not skilled at thinking about things that don't happen very often. They're not, or even if they're in their minds, that probably, quote unquote, will never happen to me. So we aren't skilled at thinking about things not certain to happen to us, and we're all overconfident that that won't happen to me. That's why they avoid these things. But our job is to do what? To address them in a manner that is the most palatable to them. And that's why long-term care without expensive annual premiums is a good way to do that. So the important insights, cash reserves are a powerful planning strategy. Think of all the potential expenditures, not just the ones we hope for. It's hard to see ourselves in all possible future states. It's helpful to segregate cash reserve funds. Guaranteed income can protect against shocks, keep all the family informed and on board as necessary, and there is no right answer. So, should we be doing all of these things? One of the things I love about 5Q is the non-financial things is a great way to get the rest of the family involved. Should you be telling your clients that, hey, it'd be a good thing to have your kids in on the fact that we have all these non-financial documents? Is that a good thing to do? Heck yeah. A guaranteed income can protect against shocks, but there is no right answer. That's why, again, we want to make sure that every time we meet with them, we go through all the non-financial things so we can plan on what's right for them right now, because we don't know what's going to happen in the future. So avoiding catastrophe helps. Historical terminal portfolio values with a 4% initial withdrawal rate on 100,000 starting balance. So again, this could be $1 million. You would just multiply these by a different number. But unfavorable sequence. So here's the best possible scenario if you're withdrawing 4% out of 100,000. The best would be your 100,000 would grow to, withdrawing 4,000 a year would grow to 912,000. The worst would be 29. It would fall you'd lose 3/4 of the portfolio at 4%. The 5th to 95, so the top 5%, 670, bottom 5%, 78,000. 10th to 90th percentile, 103,000 versus 99,000. Now, what they're not including here is what? What's that $103,000 valued at 30 years down the road? What is that 100,000 going to be valued at? Yeah, virtually pennies on the dollar, right, with inflation. And the bottom 25 and the top 25. So the 4% does work if things work out favorably. It's going to be a squeaker if they don't work out favorably. But the problem with the 4% is, what does it not include? What does that 4% not include? The black swan, David, right. The things we've been talking about, the things out of the blue. The long-term care, the loss of a spouse, the home repairs, dental, the $387,000. Do you think that this is including the $387,000 they're going to need to spend on unforeseen or above Medicare costs for health? So what would happen to these numbers if long-term care was needed? Heck, what would happen to these numbers if long-term care was needed? So possible solutions, because what we have not talked about here is what? The market. Have we even brought up the fact that the stock market could also crash and any of these things happen? And what if the market crashed at the very time that these things happened? Now what's happened to the problem? So you need to be looking at things like One America or those lump sum type things, especially for long-term care. We can plan for long-term care. We can plan for loss of a spouse. There are things we can do for our clients, and we need to at least present them to them. If we present them to them and they don't want them, then guess what? We've done our job. But if we've never presented it to them, that's a what? Yeah. So Dale says if we present it to them and they don't take them, that's on them. But if we don't present them, that's on us. Exactly. That's on us. Does that make sense? So when we're talking to folks, we're the people who can help them understand these things. Should we talk to prospects about these things? Should we talk to prospects about these things? No. No, no, no. Why do you not want to talk to prospects about these things? We talked about it earlier. Because they're unpleasant. They're not skilled at thinking about these things, and they're way overconfident. It's too shocking, right? So these are things that once they become a client, we want to make becoming a client how easy? Easy as pie. So these are going to be all things. That's why we never talk about long-term care when we're bringing a client on. When do we talk about long-term care? When do we talk about life insurance? Both things, dying and needing long-term care, are fun things or unpleasant things. Unpleasant things. So we talk about those things after they become a client. Once we have their trust, once they know we have their best interests at heart, then we can start to gently talk about these unforeseen circumstances and help them understand that they can plan for it. There are things out there that they can do. They don't have to be waiting nervously for these things to happen and then just react to them. But you can only do it after they become a client. Does that make sense? So this is about you guys realizing that is their whole world the stock market? No, the stock market affects their world. Absolutely it does. But we're not just worried. We don't have to just plan for the stock market crash. We have to plan for that. But we have to plan for the other things as well. Now, if the stock market crashes and we have a 50-50 portfolio and one of these bad things happen, are they in a better or worse situation than if they had most of their money in stocks and bonds? A little better or a lot better? At least 50% better. Lots better. Make sense? So we're still in summer, guys, so you got time to go after those crib notes and motives. You got time to practice your daily MIFs and 5-minute moneymakers breakdown once a week. And when you do that, you're going to be bringing every client you see come September on. So if you're not seeing clients, if you're not busy, get busy practicing, getting better at your skills. You guys have a great rest of the weekend. We'll talk to you all next Monday. Thanks, everybody.